Welcome to the deep dive. Today we're plunging into some really fascinating source material that grapples with the complex, often tricky world of financial market risk.
That's right. We've got sources here that really zoom in on two quite different areas.
Yeah, first, the famously volatile space of Bitcoin.
And second, the huge interconnected landscape of foreign exchange or FX markets.
And these aren't just, surface level opinions.
No, absolutely not.
Yeah.
The research we're looking at uses some pretty sophisticated analysis, digging right into high-frequency data. Think tick-by-tick price moves.
Right, and applying advanced modeling techniques to really try and capture the nuances of risk.
Exactly.
Okay, so our mission for this deep dive, let's try to unpack all this complexity, pull out the most important findings from these sources, and, well, understand what these insights might mean for how we perceive risk, maybe even how we navigate it in these markets.
It sounds like a plan. Ready to dive in?
Let's do it. All right, let's start where one of the sources does, zeroing in on Bitcoin market risk. I mean, Bitcoin is practically synonymous with volatility, isn't it?
Oh, absolutely. Its price history is just, well, a wild ride.
The source reminds us, under $100 back in 2013?
Yeah, then skyrocketing to near $20,000 in late 2017.
Only to crash, what was it, 80% through 2018?
A massive drop. And then climbing again in 2019. The swings are just incredible.
Yeah, this source notes that even within their sample period, 5-minute returns could range from, get this, a drop of over 18%
No.
to a gain of over 10% in 5 minutes.
And the sources put a number on this intensity using something called realized variance, or RV.
Right, RV. It's a standard tool in finance, isn't it? Derived from that high-frequency data.
Exactly. Basically, you sum up the squared returns over a given period, say a day or a week, to get a pretty robust measure of how much the price has actually been moving around.
And this research really puts into perspective just how much riskier Bitcoin is compared to, say, traditional assets.
It does. The annualized daily RV for Bitcoin, according to one source, is a staggering 0.86.
0.86. And for context, they compare it to something like China's Shanghai SC Composite Index, the SSEC.
Yeah, which comes in around 0.23 in their data.
That difference is, well, it's immense.
But what's really crucial about Bitcoin's price behavior, and something this study digs into, is that its movements aren't just smooth, continuous wiggles.
No, they often include these sudden, very large price shifts, what the study calls jumps.
Precisely. Jumps.
And the source points out a specific analytical challenge with Bitcoin here. It's this phenomenon of consecutive jumps.
Right, because it trades 247, reactions can be incredibly fast, and you can get multiple big moves happening really close together.
Which means a standard method for measuring jumps, like by-power variance,
BP,
it can actually miss these consecutive jumps. It smooths them out almost.
leading to an underestimation of the actual jump risk.
So to counter this bias, the researchers used a corrected method. It's called threshold by-power variance, or TBPV.
TBPV, right. And they show a really great example from May 17th, 2019.
Oh, yeah.
If you just looked at the raw price chart for that day, you'd clearly see these sudden big moves, big jumps.
Okay.
But a standard jump measure, the uncorrected BPV, it actually missed them entirely.
Miss them, wow.
But the TBPV method, the corrected one, it correctly identified those jumps.
And that wasn't just a one-off thing, right? It made a difference across their whole data set.
Or the big difference. This corrected TBPV method identified jumps on 64% of the trading days they looked at.
64% compared to what for the uncorrected one?
Only 42%.
That's a huge gap.
It is. And they also found that the average size of these detected jumps was larger with the corrected TBPV approach. So more frequent and bigger jumps were being picked up.
Okay, so they identified these jumps more accurately. Did they stop there?
No, they actually went a step further. They broke these jumps down, separating the positive price jumps, the big upward moves, from the negative ones, big drops,
How did they do that?
using a measure called realized semivariance, or RSV. Basically splitting the variance calculation based on the sign of the return.
Interesting. And what happens when you actually look at these specific jump moments? Do they connect to anything?
They often do. The research finds that these large price jumps in Bitcoin frequently align with major real-world news or events hitting the market.
Ah, so it reflects how quickly sentiment or, actual tangible news can hit this market.
Exactly. It's not just random noise. For instance, the source highlights the SEC denying the Winklevoss ETF back in March 2017.
Right, I remember that.
That shows up as a clear example of a specific event lining up with a large negative jump they detected using their methods.
So it gives some empirical weight to the idea that these aren't just statistical blips. They're often the market reacting, sometimes quite violently, to significant information.
Precisely. Information hitting the wire, as they say.
Okay, so we've explored how the sources measure past risk in Bitcoin, its overall volatility, those sudden jumps, correcting for measurement issues. Now, this is where it gets really interesting for me. Can we actually predict this future volatility?
That's the million-dollar question, isn't it? The sources tackle this using forecasting models, specifically a class of models known as AAR-type model.
AAR models, right.
Okay.
Remind us briefly what those do.
Sure. Think of them as models that try to forecast future volatility, say tomorrow's RV, by looking at different past measures of volatility. Usually involves like daily, weekly, and monthly components of past RV.
Okay, looking back at different timescales.
Yeah, and sometimes these models also incorporate other factors, like the jumps we've been talking about. So you might have an HER RPJ model, where J stands for jumps.
Got it. And what did the results show when they ran these models over their whole data sample?
Well, some key things came out. First, as you'd probably expect, if past volatility was high, the models predict future volatility will also be high. That lagged volatility is a strong predictor.
No huge surprise there. High volatility tends to cluster.
Exactly. But here's a finding from that full sample analysis that feels a bit counterintuitive.
Oh.
Daily jumps, particularly the positive ones, the big upward spikes,
Yeah.
they actually seem to reduce the predicted future volatility significantly, especially when forecasting further out, like 7 days or 30 days ahead.
Reduce future risk. A big positive jump makes things calmer later. That feels backward.
It does feel odd, doesn't it?
Yeah.
The study doesn't give a definitive why, but you could speculate.
How so?
Well, maybe a large sudden move up exhausts the immediate buying pressure.
Huh.
Or maybe it creates enough uncertainty that the market just sort of takes a breath afterwards.
Interesting thought. Like the storm passes and there's a lull.
Something like that. The data, at least in that full sample view, pointed towards this unexpected calming effect on subsequent volatility over those medium-term horizons after a big positive jump.
But I mean, the Bitcoin market is hardly static, right? It changes all the time.
Absolutely.
Yeah.
And the researchers acknowledged this. That's why they also used what's called adaptive forecasting.
Which means?
Instead of using the entire data set at once, they run their models over a rolling window of data. In their case, it was a 90-day window.
Ah, so the model constantly updates based on the most recent market behavior?
Exactly. It allows the models to adapt as the market itself evolves.
And what did this adaptive rolling window analysis show? Did it confirm the weird jump finding?
It gave more nuanced, maybe more practical picture. The key finding here was that including those separated positive and negative jumps can significantly improve predictions of future RV,
Okay.
but primarily for the longer forecasting horizons. Specifically, 30 days out.
So a month ahead, knowing about recent positive or negative jumps helps predict volatility.
It seems so, based on their adaptive models. But for very short-term forecasts, like just predicting tomorrow's volatility 1 day ahead, adding those jump components didn't really improve the accuracy much, if at all. Often their impact was statistically insignificant in the short run.
Okay, so let's boil this down. What does this mean for you, the listener, maybe thinking about forecasting Bitcoin's risk?
Well, the out-of-sample forecasting tests in the research give a pretty practical takeaway.
Which is?
If you're trying to forecast Bitcoin's realized variance over a longer horizon, say a month out, then explicitly identifying and modeling those jumps, and importantly, separating them into positive and negative, seems beneficial. It gave them better accuracy and potentially higher economic utility for an investor using those forecasts.
What?
But if your focus is just on the very next day's volatility,
Like super short term.
yeah, then the data suggests adding all that complexity about jumps doesn't really buy you much. Simpler models based just on past volatility measures, those basic HAR models, were pretty much just as good for that one-day window.
So the value of modeling jumps really depends on your forecasting horizon.
That seems to be the key message here. Longer horizon, jumps matter more, socially signed jumps. Shorter horizon, maybe not so much.
Fascinating how the prediction challenge changes like that. Okay, let's shift gears completely now.
Right.
Let's look at a totally different market, the massive world of foreign exchange, FX. Our second set of source material gives us a different lens on risk, focusing on something called correlation regimes.
Yeah, this study takes a broader view. It used a specific type of statistical model, a regime switching model.
Regime switch.
Basically, it's a model that can detect when A system, in this case the FX market, seems to switch between different underlying states or behaviors. They applied this to data from the G10 currencies, the big developed economy currencies.
Okay, covering a decent time span too, right?
Yeah, 1995 to 2013.
Hmm.
And they identified two main states or regimes that the market seemed to flip between.
What were they?
A high correlation regime, where currencies tended to move more closely together, and a low correlation regime, where their movements were less synchronized.
High correlation and low correlation states. Okay. And did these shifts mean anything?
That's the crucial part. They found that the transition from the low correlation state to the high correlation state.
When everything starts moving together more tightly.
Exactly. Those transitions precisely corresponded to major historical periods of financial stress and crisis.
Really? Like what?
They actually list them. They characterize these low to high transitions as risk-off episodes. And they explicitly link them to events like the Asian crisis in the late 90s, the Russian default, the dot-com bust, the subprime crisis starting in '07, and the European debt crisis.
Wow. So a switch to high correlation is basically a market-wide panic signal in their model.
That's a good way to put it. A flight to, well, somewhere, where everything moves in lockstep, usually driven by fear.
Which naturally raises the question, how do different types of currencies behave during these regime shifts?
Good question. During those risk-off transitions, when correlation spikes from low to high, the study finds a very clear flight to safety within the currency market.
I mean,
Currency is traditionally seen as safe havens, the US dollar, the Japanese yen, the Swiss franc.
yeah, the usual suspects.
They tend to appreciate significantly during these risk-off episodes. Money flows into them.
While other currencies.
Currencies often considered investment currencies, maybe because they offer higher interest rates or are tied to commodity cycles, like the Australian dollar, the New Zealand dollar.
The commodity currencies, right?
Those tend to depreciate sharply. Money flows out.
Makes sense. A classic risk-off pattern.
It does. And they show this isn't just theory. It's backed up by actual market positioning data.
Hmm.
Looking at speculators' futures positions, you see this big shift into long positions in safe currencies and out-of-investment currencies during these risk-off periods.
People voting with their feet, or their capital, rather.
Exactly.
And presumably, the opposite happens when things calm down, when correlation shifts back from high to low.
That's right. During those transitions, which you might call risk-on periods, those riskier investment currencies tend to see significant appreciation. The flow reverses.
So, this dependency of currency movement on the market's overall correlation state is a core insight here. It's not just about individual currency news.
Absolutely. The broader market mood, as reflected by correlation, seems to be a major driver.
Okay, so how do these correlation regime transitions actually impact returns? Particularly for common trading strategies. This is where it starts to really hit home for anyone involved in FX, I imagine.
Definitely. And this source highlights a really significant finding about one very popular strategy, the carry trade.
Ah, the carry trade. Borrow low, lend high.
Exactly. Borrowing in a currency with a low interest rate, like the yen for much of this period, and investing in a currency with a high interest rate, like the Aussie dollar.
How does it fare during these regime shifts?
Well, this is where it gets quite dramatic. During the transition from low to high correlation, those risk-off moments tied to crises,
Yeah.
the carry trade gets hammered. It experiences substantial losses. The study puts a number on it. Average losses were around 34 basis points per day immediately following that low to high transition signal.
34 basis points, so
Yeah.
0.34% per day.
Yeah, and that adds up quickly. They estimate cumulative losses reached around 200 basis points, or 2%, over the 20 days following the signal. That's a serious drawdown in a short period for what's often seen as a slow grind strategy.
Wow, yeah, losing 0.34% a day is definitely not a slow grind. That can wipe out months of gains.
It really can. But conversely,
Let me guess, when correlation shifts the other way from high back to low.
exactly, risk on. The carry trade sees significant profits. The research shows average daily returns were also around 34 basis points positive during those transitions.
Same magnitude, opposite sign.
Pretty much. Which, if you were to annualize just those specific transition periods, represents a massive potential return. They calculated something like 86% per year just during those specific regime change windows.
Of course, catching those transitions perfectly is the trick.
Always the trick, but it shows the potential magnitude.
The study also mentioned something about the carry trade's sensitivity to volatility changing, right? It's often called its volatility beta.
Yes, that was another really interesting finding. It's not just a simple rule like high volatility always hurts the carry trade.
Which is often the assumption.
Right. But this research reveals the carry trade's response to volatility shocks isn't fixed at all. It completely changes depending on which way the correlation regime is transitioning.
How so?
Well, sometimes you see that expected negative relationship, meaning the carry trade loses money when volatility spikes, which happens during those risk-off, low-to-high correlation shifts.
Okay, that fits the narrative.
But surprisingly, when correlation shifts from high back to low, the risk-on phase,
Yeah.
the carry trade can actually show a strong positive relationship with volatility. It almost acts like a hedge against volatility in those specific periods.
So it benefits from rising volatility when the market is shifting back towards risk-taking.
That's what their analysis suggests. It's quite counterintuitive based on the standard view.
So understanding which correlation regime you're in or transitioning between is absolutely crucial. It gives you an edge beyond just watching a standard volatility index like the VIX.
It seems so. The context of the correlation matters just as much, if not more, for predicting how the carry trade might perform and what its risk exposure actually looks like at that moment.
And did they find these effects were just limited to the G10 currencies they focused on?
No, they mentioned the implications ripple outwards. These correlation regime shifts in the major currencies also significantly affect emerging market exchange rates.
Okay, contagion effects.
Yeah, and even global equity markets. They noted that global stock indices suffered really extraordinary losses precisely during those low to high risk-off correlation transitions.
So it really highlights the systemic nature of these shifts. When the correlation structure changes in FX, it's often part of a much bigger market-wide event.
Absolutely. It's a powerful reminder that these seemingly technical market dynamics, like currency correlations, can be deeply intertwined with widespread real-world financial stress.
All right, let's try and bring these two deep dives together now. We've looked at Bitcoin, the extreme jumps, the challenges in measuring them, how they influence volatility forecasting differently depending on your time horizon. And then we looked at the huge FX market, seeing how broad shifts in currency correlation act like distinct regimes, dictating safe haven flows, wrecking or rewarding carry trades, and signaling systemic risk.
And both sources, though using different data, focusing on different asset classes and looking at different types of risk jumps versus correlation.
Yeah.
They really seem to converge on a similar fundamental truth about financial markets.
Which is?
That the nature of market risk isn't static. It's not constant. It heavily depends on the specific conditions, or you could say regimes, within the market itself at that time.
Right, whether it's the presence and the type of price jumps for understanding Bitcoin volatility.
Or the current state and the direction of change in market-wide correlation for understanding FX returns and strategy effectiveness.
The context fundamentally alters how risk behaves and how it impacts outcomes.
Exactly.
Yeah.
And both studies really underscore the value of, well, drilling down into the details.
Yeah.
Using that granular high-frequency data and applying sophisticated analytical tools to uncover these context-dependent dynamics.
Yeah, these aren't insights you typically get just from looking at daily closing prices or simple moving averages.
No, definitely not. They provide crucial information that potentially could inform better forecasting and maybe even smarter trading decisions.
So we've journeyed from the kind of unique jump-driven volatility of Bitcoin to the powerful, almost tidal, regime-dependent dynamics of correlation in the global FX market.
And the core takeaway seems pretty clear and consistent across both. Understanding the specific types and behaviors of risk is essential.
Whether it's those sudden price jumps or these broader shifts in how assets move together?
Right, because their impact on future volatility, on returns, it isn't uniform. It's not a simple, constant relationship. It fundamentally depends on the specific market context you're in, and as we saw with Bitcoin, the investment horizon you're focused on.
Okay, so here's a final thought then for you, the listener, to maybe ponder.
Okay.
If sudden shocks, jumps in one market like Bitcoin can surprisingly sometimes reduce future volatility over certain horizons.
Yeah, that counterintuitive finding.
And shifts in co-movement, those correlation regimes in another massive market like FX, are tightly linked to major crises and can completely dictate whether a strategy like the carry trade wins or loses. Then what other hidden, context-dependent risk dynamics might be shaping the markets you care about? Dynamics you perhaps haven't even considered yet.
That's a great question. How does the specific context, the regime, change everything in your market focus?
Something to think about. Thanks for joining us for this deep dive.
Thanks for listening.
We'll catch you next time.